want to go on and talk about these next two kinds of fundamentalisms that I think are important in understanding the United States, its political arena, and therefore the role of journalism. First, economic fundamentalism. We've touched on this briefly in the first section of the class on democracy and the relationship of democracy to the economic system, the relationship of the political to the economic, the relationship of democracy to capitalism. Right? Economic fundamentalism. You'll also hear the term market fundamentalism or free market fundamentalism. These are terms that are now widely used in discussions about the economy. The defining characteristic of this economic fundamentalism, I think, are the naturalizing of capitalism and of markets as a vehicle to distribute goods. The naturalizing of capitalism, what do I mean by that? I think in this country, hearkening back to things I said earlier in the semester, capitalism as a way to organize an economy is asserted not simply to be the best, most appropriate way to organize an economy. It is presented to us really as the only sane and rational way, the natural way to organize an economy. That at this point in history, capitalism, especially in its existing form, sort of corporate capitalism, is presented to us as the only sane, rational, in fact, the natural way to organize an economy. And one of the distinctive characteristics of capitalism is markets, and especially a certain conception of free markets as the way to deal with the distribution of goods. Okay. Now, what I want to do is draw on some expertise through the computer and try to flesh out how this plays out. And then we'll talk also about how this is important for journalism. So what I want to play you right now is a short clip from a discussion that's going to involve a questioner and then two participants. One is Joseph Stiglitz, and the other is Naomi Klein. Joseph Stiglitz is a Nobel Prize-winning economist. He's one of the big guns. Joe Stiglitz, he teaches at Columbia University now. He was at one point the chief economist for the World Bank, International Lending Organization, and he's held various other positions in government as well as in academic life. So Joe Stiglitz is a classically trained economist, right, with experience both as a scholar, researcher, and teacher, as well as a political appointee at both the national and the international level. Naomi Klein is a journalist. She's from Canada. She's written two important books, I think, in the last 2 decades now. One called No Logo, which came out in the late 1980s, which was an inquiry into the way that branding has changed our lives. You grew up in a world of brands, yes? You all have your favorite brands. You know, you all have your favorite coffee place, your favorite jeans, your favorite shoes. Naomi Klein's first book looked at the rise of branding. Right. One of those things that, this is often the case, it's the world you were born into and you know, but it's part of a shift in culture. Her second book, or her second important book, was called The Shock Doctrine, which came out a few years ago, which was an examination of this market fundamentalism. So what I'm going to do is play you an extended clip of them talking about it. The question is going to be asked about how to understand some of the aspects of the current economic crisis, especially the rise of a market in derivatives. Some of this is economic language, and it may not be entirely clear to you. The specifics, I'm not all that worried about, but you know the general outlines, that in 2008, the financial markets in this country collapsed. And part of it had to do with these new credit instruments that had been developed. Many were called derivatives. You heard about the way that mortgages, home mortgages, in the old days, you had a mortgage. You went to the bank, you signed the papers, you had a mortgage. You paid the bank every month. At the end of 30 years, you owned your house. Right? That was a standard way that the financial system worked. Today, mortgages get bought and sold. You go and take out a mortgage at a bank. 6 months later, the bank may sell that mortgage to some other institution. Those mortgages may get bundled. And then somebody buys a security based on this bundle of, and we all know that because some of those mortgages were not good, that that this created a crisis in the financial system. So when they're talking about derivatives, they're talking about this very special way that the financial system in the United States has moved from a fairly straightforward borrower, creditor, you pay back the loan kind of model to this incredibly complex financialization of the economy with credit default swaps and all sorts of words that, quite frankly, when I hear them sometimes it just makes my head hurt because I don't quite understand it all. And they're going to talk about that, and I think it will shed some light on this notion of market fundamentalism or economic fundamentalism. So pay attention to Stiglitz and Klein. We'll start with the question.
There are a whole bunch of this, that actually there are a whole bunch of new markets which have been constructed over the last 15, 20 years. In 1990, these markets didn't exist, and these are the markets in derivatives on currency and interest rates and credit and all the rest of it. And a couple of years, 3 or 4 years ago, I saw this item which kind of said, you know, there's $260 trillion now circulating in these markets. And actually the latest data I have, which is for September, is the $600 trillion circulating in these markets against what you said, $55 trillion
Absolutely.
total output of goods and services in the whole world.
Right.
So you've got something that's a factor of 10 still circulating in these markets. Now, the interesting thing is, people have extracted immense wealth from those markets. I mean, the 3 or 4 leading hedge fund people last year got $3 billion in personal compensation coming out of this. So, at the same time as 2 million people are losing their homes to foreclosures, you know. So, you know, you then say, well, there's something really wrong going on here. Now, the question I have is, who created these markets? Who had the power to do that? How did they get in there, and how did they extract wealth from it, and who's got hurt from it? And by the way, what are we going to do about those markets? Because you're exactly right. Nobody knows what on earth is going on there. I mean, I try to read the stuff coming out of Wall Street, and it's almost impossible to find. So what are we going to do about those markets, considering they did not exist in 1990? Joe, let Joe have a go.
Okay. I mean, these are sort of a natural evolution of a, you might say, a property-based system, of a free market system without regulation. Yeah, this is just sort of, the way to think about this is 2 individuals make a bet about what's going to happen to a share. Okay, you have a share, that's a piece of property. And then we say, well, what's going to happen to that? I can have the right to, you know, what's wrong with I have a dollar bill, I can bet that dollar bill about whether that share price is going up. Well, we stop at $1, that's one thing, but we can make $1 billion bet on what's going to happen. Now, there's a little bit of a problem. I might not be able to actually deliver that amount of money if I don't have the security. But what really the way to think about much of what has happened is these are gambling markets. People are gambling on the outcome of particular events, and you can gamble on anything. It used to be you gambled on horses. Well, that's not very sophisticated because you think there's a random element and you don't really know. People study those racing things, but most of us think that that's not very sophisticated. So in modern America, what you do is you become smart and you study companies. And you and I will study the company and we'll say Bear Stearns is going to go bankrupt. And we bet on Bear Stearns going bankrupt, and we bet $1 trillion on Bear Stearns going bankrupt. And so what happens? Well, when it comes to going bankrupt, if it does go bankrupt, the guy who said it won't go bankrupt goes bankrupt. And what happens then? The federal government comes and bails you out. So that's how these numbers can get so large. But it's an unregulated free market. It's what capitalism, unless you have regulation, is going to lead to under a private property law system.
And that's what I think is really useful about this moment, is that, you know, we actually do know who created this market pretty much. It was Alan Greenspan. You know, it was. And, you know, several key decisions that he led, he had help, but he led the way and fought tooth and nail. And what's interesting now is there's some really good investigative reporting going on at the New York Times and the Washington Post, really trying to figure out what those key decisions were. And I've been reading, the transcript of the Senate subcommittee hearings where people like, Ed Markey was fighting him in 1994 saying, why aren't we regulating the derivatives industry when we regulate other aspects of the financial industry? What is so special about this industry? And what Greenspan argued was that these were arrangements, these were deals that were made between professionals, and they should be trusted to self-regulate. He said they're too complex for the government to regulate. And now, when he's been looking at this mess, he won't say he made a mistake. What he says is that he did not realize, well, what he was counting on was that trust and reputation mattered in the banking industry, and it turns out it doesn't. It turns out that golden parachutes and multi-million-dollar bonuses are a mitigating factor, okay, to the destruction of your reputation, okay? But what's interesting about this, I think, from a theoretical perspective, is that if we think about this idealized free market, right, out there in the world that Milton Friedman dreamed about, those market fundamentalists could always win an argument because there was no truly free market anywhere in the world, and they could always blame some piece of regulation that was in the way, that was interfering with the signals. But actually, we now can look at what a truly deregulated market looks like. It looks like the derivatives industry.
Can I make one more comment on this, which is, and pick up on this notion of the decision makers. The decision makers were the CEOs, the managers. 75 years ago, Berlin Means pointed out that there's been a fundamental change in capitalism. That the old story that still is in the textbook is of a company that is owned by the person. If he makes a mistake, that person bears the consequences. Modern capitalism isn't that way. It's a separation of ownership and control. And so the guys who are under control are effectively interested in maximizing their own well-being, not any other stakeholder. And there are incentive structures that do this, that give them a great latitude. Corporate, the underlying fundamental problem that is just beginning to be discussed is it's not just bad regulation of the banking system and the financial system, it's bad corporate governance, which is pervasive in our economy. So you take one particular provision, stock options. The stock options encourage the CEOs to get reported earnings high. What did that mean? Bad accounting, put stuff off the balance sheet. We knew this. We knew this back after the Enron and WorldCom. Actually, back in 1994, 95, I was in, when I was in the Council of Economic Advisors, we tried to change that. And people like Rubin opposed that. People in Wall Street opposed it. There was a party just beginning, and nobody wanted to be a party pooper.
Very quickly, he mentions at the end when he was involved in discussions in government and they were trying to raise these issues, and he said Rubin opposed that. That's a reference to Robert Rubin, who was Secretary of the Treasury in the administration of Bill Clinton. So one thing to point out here. None of what you just heard had anything to do with political parties for the most part. It was a critique of a system, not of the way one particular politician or party handled this. Okay? So let's step back. I realize what I did was just kind of drop you in the middle of a somewhat complex discussion about modern economics and financial markets. And it's hard to pull it all apart. But let's step back and ask what was useful in that segment. There you had an economist and a journalist trying to untangle some of the events of recent years that have led to a serious crisis in the financial system and, in fact, in the world economy. Right. They're dealing with questions of ideology. Naomi Klein makes the point that this credit derivatives market that we're talking about, that produced all these complex financial interactions which eventually, led to the crisis, they were not regulated. She says, if you want to see how markets, truly free markets work, this was a truly free market. That even government regulators sometimes didn't understand what was really going on. Right? And so she's saying it's a test case of what markets really do. When you have completely free markets, she said, it led to this. So what she's doing is stepping back and saying, let's not just look at the very sort of cut and dried facts of what happened. Let's step back and use this to examine the ideology that has informed our understanding of economics. Stiglitz is doing the same thing. He's saying, listen, things have changed. We have to understand how they've changed. So the point I'm making is that there is an ideology that dominates our understanding of how the economy works. Right? There will be competing ideologies, but in the culture there is a dominant ideology. And that ideology I am calling an economic fundamentalism, perhaps a market fundamentalism, in which capitalism is naturalized, markets are presumed to be the most efficient way to distribute goods. And all of that informs the way we talk about economics, and it informs the way journalists write and broadcast about economics. And what we just saw was people stepping back and questioning that ideology. Now, the point I want to make, I've made many times before, whether you accept the dominant ideology or you question it, you're being ideological. You're choosing either to accept the dominant ideology and the assumptions behind it, or you're questioning them. But when you write or create a television broadcast or a radio story, whatever you're doing, you're in one of those two positions. And what we're going to see over and over again is that mainstream journalism, that corporate commercial journalism that defines the industry and provides the bulk of the news that most people consume, tends to stay within the dominant ideology. That much of the reporting on the financial crisis, for instance, even when it was pointing out the problems, was still safely within that dominant ideology. It was reporting on the crisis, but not reporting, in a sense, on the ideological assumptions behind the crisis. So, we're suggesting that everyone has an ideology, but there are dominant ideologies, and we're trying to look at how journalism relates to them. We talked about national fundamentalism, economic fundamentalism.